We've discussed retained earnings a few times throughout this chapter, but now we will explore it a little deeper, including the preparation of the retained earnings statement. Retained earnings is the total cumulative amount of reported net income, minus any net losses and dividends declared. It is part of stockholders' equity, which is the owner's claim to the assets, and does not mean that any certain amount of cash or other assets actually exists. Restricted retained earnings refers to both statutory and contractual restrictions. Appropriated retained earnings refers to a voluntary transfer of amounts from the retained earnings account. Many times, a company cannot pay out dividends due to restrictions on retained earnings involving debt agreements. Retained earnings has a credit balance because it is an equity account. Therefore, credits will increase the account and debits will decrease the account. I made a little T account here in the middle. The items listed on the left will be the debits or the decreases, and the items on the right will be the credits or the increases. Let's look at the decreases first. A net loss reduces retained earnings. Paying out dividends will decrease retained earnings as well. This includes both cash and stock dividends. Having net income will increase the retained earnings account. You won't have both a net loss and net income. It would be one or the other. Remember, the company earns money, which goes into retained earnings. Then it will keep some of it in the account and will sometimes pay out some in the form of dividends. Another item that affects retained earnings would be any prior period adjustment. This is when a mistake or error is discovered in a prior year. We can't merely fix the mistake because the books have already been closed and financial statements have already been issued. However, since income is close to retained earnings, we can adjust the current retained earnings account. This is because the amount in the retained earnings account would be incorrect if the wrong amount was close to it. If there was an overstatement of net income in prior periods, then a higher amount was close to retained earnings, causing the account to be overstated. In order to fix retained earnings, we need to debit the account so as to bring the balance back down. To fix an increase, you make a decrease. The reverse is also true. You will credit retained earnings for prior period adjustments of understatement of net income. Since retained earnings does not have as much as it was supposed to, we need to add it in so that it is correct. Here's a little summary of that. If net income is overstated, you would reduce retained earnings. If net income is understated, you would increase retained earnings. Here's our last practice problem of the chapter. It's number 8. The following information is available for Orange Co. for the year ended December 31st, 2017. Prepare a statement of retained earnings. The balance of retained earnings on December 31st, 2016 was $1,375,000. Cash dividends declared and paid during 2017 was $43,000. It neglected to record 2015 depreciation expense of $55,500, and the company earned $126,000 in 2017 net income. To prepare the retained earnings statement, you begin with the beginning balance. If there were errors, you want to fix that first. Then you include any additions, then the subtractions to the account, then you arrive at your final ending balance. What did the retained earnings statement start with? It would be the amount from 12/31 of 16, last year's ending amount. The amount would be $1,375,000. Next, you want to do any adjustments to fix this number. This is the most complicated part. If there was an error that was not fixed, then technically this amount here is wrong. We label the next part prior period adjustment. What was the adjustment or error? It neglected to record 2015 depreciation expense of $55,500. Now, do we add or subtract this amount? Last year, we did not record an expense by mistake. How did that affect our income? If you didn't have a monthly expense one month, then your income would be higher, correct? So last year, our net income was higher than it was supposed to be because we forgot to include an expense. If last year's income was greater than it was supposed to be, how do we fix it this year? We would subtract. This is because the $1,375,000 beginning balance is too high by $55,500. We then write out our adjusted retained earnings, which is really the correct amount. It is $1,319,500. This is really what our beginning retained earnings should have been if we never made the mistake. Now we do the additions. What gets added to retained earnings? Net income does. How much was our net income? It was $126,000. Next, we do our subtractions. What do we have in this example that gets subtracted from retained earnings? It would be the dividends paid. How much were the dividends? It was $43,000. Lastly, we get our final balance for the end of the year. We use our adjusted retained earnings balance of $1,319,500. We add our net income of $126,000 and subtract the dividends of $43,000. We arrive at an ending balance of $1,402,500.